What if I told you a company can report record profits while its actual business is getting weaker? And what if that warning sign was hiding in plain sight inside the financial statements? Today, I'll show you how companies manipulate earnings, the accounting tricks investors should recognize, and the real-world examples that fooled millions. Some of the biggest corporate failures in history reported healthy earnings before collapsing. Later in this video, I'll show you the single accounting metric that often exposes manipulation years before collapse. But first, we need to understand what earnings manipulation actually is, and why it's not always illegal. Earnings manipulation does not necessarily mean fraud. Sometimes management simply uses accounting flexibility. They use this flexibility to make results look better than reality. Think of it like editing a photograph. The picture isn't completely fake, but it may no longer represent reality accurately. Investors often focus on earnings per share, or EPS. Management knows this, and that creates incentives to present earnings in the most favorable way possible. Now let's look at the first trick. Let's start with trick number 1, revenue recognition. It's all about the timing of when a sale is recorded. Imagine a company signs a 2-year contract worth $100,000. Normally, revenue should be recognized gradually as services are delivered over that time. But aggressive accounting may accelerate recognition into the current period. Suddenly, today's earnings look stronger. The business hasn't changed, only the timing changed. This is a classic real example trap. There's also a trick called channel stuffing, shipping excess inventory to distributors at year-end. By stuffing the channel, the company books immediate sales, even if the distributors return the goods later. This artificially boosts current earnings at the expense of next year's sales. It's a dangerous borrowing game. One famous example was Enron. They perfected this timing game through mark-to-market accounting. Projects expected to generate profits over many years suddenly boosted earnings on day one. The reported profits looked impressive, but the underlying cash never arrived. It was just paper wealth. When the projects failed, the massive paper profits vanished, leading to immediate bankruptcy and collapse. That brings us to trick number 2, expense manipulation, pushing costs into the future. Imagine repairing a major office building. This is an ordinary maintenance expense. Instead of recording the cost today, management may classify it as an asset and spread it over future years. Current earnings improve immediately because the cost is hidden in the balance sheet. This is the difference between capitalizing and expensing. Capitalizing creates an asset. Expensing lowers profit. When ordinary operating expenses are capitalized, the income statement looks incredibly clean and profitable. WorldCom became one of the largest accounting scandals in history using exactly this trick. The company improperly classified billions of dollars of operating line costs as long-term capital assets. By doing this, they hid over $11 billion in expenses, making them look highly profitable. It was only uncovered when internal auditor Cynthia Cooper launched a secret night audit. They found the hidden entries and exposed the fraud, leading to WorldCom's immediate collapse and bankruptcy. Now let's explore trick number 3, cookie jar reserves. This is a game of income smoothing. In highly profitable years, management may overestimate bad debts or future warranty expenses. These excess estimates are tucked away in a reserve account on the balance sheet, the cookie jar. When earnings are weak in a future year, they release those reserves to artificially boost profits. This makes the company's performance look remarkably stable, even when the underlying business is declining. It hides the natural volatility of the business, giving investors a false sense of security. It's a silent trap. So how do you protect yourself? Here's the accountant-level secret weapon you must use. It's the statement of cash flows, specifically looking at cash flow from operations. When earnings rise, but operating cash flow does not, a massive red flag appears. Accountants trust cash flow more than earnings because cash is much harder to manipulate. You can adjust estimates, change depreciation, or accelerate revenue, but you cannot fake actual cash in the bank. A growing gap between net income and cash flow is the single biggest warning of earnings manipulation. If a company reports $50 million in net income, but only $10 million in operating cash, ask where the cash went. Often, the cash is trapped in unpaid customer bills or unsold inventory that may never be converted to real money. To help you navigate this, here is your 5-step investor checklist to use on any stock. First, is revenue growing faster than operating cash flow? If yes, investigate immediately. Second, are accounts receivable growing faster than total sales? This indicates unpaid bills are piling up. Third, does management constantly exclude expenses from their self-defined adjusted earnings? Fourth, are there large, frequent, one-time or non-recurring adjustments every single year? And fifth, did the company suddenly change its depreciation or revenue policies? Look closely at the footnotes. The most important details are always buried in the fine print of the annual report footnotes. Don't skip them. Let's look closer at Enron's footnotes. They disclosed related party transactions that hid their massive debts. These entities, controlled by the CFO, were used to absorb Enron's losses and keep them off the main books. On paper, Enron looked debt-free and highly profitable, but the footnotes revealed the house of cards to those who read them. At WorldCom, the footnotes showed their capital expenditures were abnormally high for their industry. They were spending billions on vague assets that had no clear economic purpose or future return. An alert analyst comparing CapEx to competitors would have spotted the abnormality years before the collapse. Income smoothing is another practice to watch out for. It's about keeping earnings predictable for Wall Street. Real businesses are volatile. If a company's profits grow exactly 12% every single year, be skeptical. Perfect stability is often an artificial creation of the accounting department, not economic reality. Always check if the company is changing its accounting policies to meet quarterly expectations. Extending the useful life of assets from 5 to 10 years immediately lowers depreciation expense and boosts profit. The company's operations didn't improve at all, but they just created millions in paper profits with a pen stroke. The biggest investing mistake is assuming reported earnings equal business quality. They don't. A company can manipulate and manage its earnings for years, but eventually cash flow always catches up. The most successful investors don't just read the headline profits, they follow the cash flow. Always ask, where is the cash? If it's not in the bank, the profits are likely an illusion. The key lesson from today is simple. Profits can be managed, but cash flow is much harder to fake. If you want to think like an accountant and protect your portfolio, look beyond the headlines. Subscribe to Accountant Investor for more institutional, evidence-based investing insights. This content is for educational purposes only and should not be considered financial advice. See you in the next one.